Regular investors are quietly making thousands per month with these ETFs. I'm one of them, over $4,000 monthly since 2022. But one wrong pick in this category can wipe out your gains. But what if the finish line was drawn in the wrong place? Because right now, there are everyday investors, not Wall Street professionals, not people born into wealth, who are generating thousands of dollars every single month in real, consistent income, not from a $2 million nest egg, from a fraction of that. And they're not waiting for retirement age to do it. I know this because I'm one of them. Since 2022, I've been building a covered call ETF portfolio from the ground up, testing, refining, and learning. And today, that portfolio consistently generates over $4,000 every single month. That's real money hitting a real account. Not a back test, not a projection, real life. And in the next 20 minutes, I'm going to show you exactly how this works. The specific ETFs across 5 categories, the math behind the income, and the criteria I used to filter through over 190 funds to find the ones actually worth your attention. Stay until the end because the highest yielding fund on this list comes with some critical nuances that could make or break your decision. You don't want to miss that. Before we get into the funds, we need to fix something most videos completely skip, and it's the exact reason beginners end up choosing the wrong ETFs in this category. Because on the surface, these all look the same: high yield, monthly income, simple. But underneath, very different outcomes. Here's what a covered call ETF actually does and where most people misunderstand it. At its core, it's doing 2 things at the same time. First, it holds a portfolio of assets, stocks, an index, sometimes even gold, depending on the fund. Second, and this is where the income comes from, it sells call options on those assets. Think of it like owning a property. You still own the property, but now you're renting it out every single month. That rent, that's your income stream. Sounds ideal, right? Here's the part most people gloss over. In exchange for that consistent income, you're giving up part of your upside. If the market takes off, you don't fully participate. And that's not just a small detail. That one trade-off is what separates a stable income strategy from a portfolio that slowly underperforms over time. Some investors understand this and use it strategically. Others chase the highest yield and don't realize what they've given up until it's too late. So before you look at a single ETF, you need to understand this dynamic clearly. Because once you see how this trade-off actually plays out, you'll start to notice that not all covered call ETFs are built the same, and some of them come with risks that aren't obvious at first glance. Now, let's break down what separates a high-quality covered call ETF from one that can quietly hurt your long-term returns. I've personally tracked over 190 covered call ETFs available to US investors, and here's the uncomfortable truth. Most people don't fail with these funds because the strategy is broken. They fail because they chase yield blindly, without understanding what's actually happening underneath. And that's where things start to go wrong. So instead of guessing, I built a strict filter, one that eliminates the funds that look good on the surface but quietly fall apart over time. Here's exactly how it works. First, a distribution rate of at least 10%. This is the real income the fund is paying right now, not what it paid 12 months ago. Because one of the easiest ways to get misled in this space is by looking at trailing yield. It looks high, it looks attractive, but in many cases it's already dropped and you wouldn't know until your income starts shrinking. So this filter makes sure you're seeing what's actually happening today. Second, a total return of at least 15% over the last year. Because income alone can be deceptive. A fund can pay you every month and still lose value quietly in the background. Total return forces both pieces into the same picture, income and price movement. If those don't work together, the strategy breaks. Third, positive price returns. This is the NAV erosion test. If a fund is paying you 20% but dropping 15% in price, you're not making money. You're just getting your own capital handed back to you in smaller pieces. We eliminate those entirely. These three filters used together are what separates sustainable monthly income from what is essentially a slow financial trap. And here's where it gets interesting. Once you apply these filters across 190 plus funds, the list shrinks fast. A lot of popular names don't make the cut. So before we jump into the actual ETFs, let me show you what this looks like with real numbers, because this is where everything starts to click. Let's make this real with numbers, because this is where everything starts to click. Take $500,000 and invest it three different ways. A traditional dividend aristocrat portfolio, stable, conservative, widely trusted, yields around 2.6 to 2.7%. On $500,000, that's about $13,000 a year, roughly $1,100 a month. Reliable? Yes. Life-changing? Not really. Now, take a high-yield covered call portfolio at around 11%. Same $500,000 now generates about $55,000 a year, or roughly $4,500 a month. That's a completely different level of income. But here's where you need to be careful. That higher income doesn't come for free. It comes with trade-offs we talked about earlier. Now push it even further. At ultra-high yields around 20%, you're looking at $100,000 a year from the same $500,000, over $8,000 every single month. On paper, that sounds incredible, but this is exactly where most investors make their biggest mistake, because at that level, yield stops being just income and starts becoming a signal that something underneath might not be sustainable. This is where NAV erosion, poor structure, or aggressive option strategies can quietly eat into your capital while still paying you on the surface. So yes, covered call ETFs can absolutely change the equation. They can reduce the amount of capital needed to generate meaningful income, but only if you understand which yields are healthy and which ones are quietly working against you. Because the difference between 11% and 20% isn't just more income, it can be the difference between a strategy that pays you consistently and one that slowly drains your portfolio over time. So now that you understand the math, let's get into the funds that actually pass the test. Category 1. S&P 500 Covered Calls, the foundation. Every income portfolio needs a foundation, and for most investors, that foundation is the S&P 500. But here's where the mistake usually starts. Most people just buy a simple index fund, collect around 1 to 2% dividend yield, and wait. Safe, yes, but for income-focused investors, it's extremely limited. So instead, we apply a covered call layer on top of the same index to increase income while still staying tied to the S&P 500. But this is where your first real decision risk appears, because not all S&P 500 covered call ETFs behave the same way. The standout fund here is TSPY, Top Alpha SPY Growth and Daily Income. TSPY uses what's called a zero DTE strategy, 0 days to expiration. In simple terms, every single day the fund sells options that expire the same day. That means every morning the strategy resets completely. And this is where things get interesting. This structure allows TSPY to generate a 14.7% distribution rate. That's a massive jump compared to traditional S&P 500 income. But here's the trade-off you cannot ignore. Because options are sold so close to current market price, your intraday upside is capped. So if the market runs strongly in a single direction during the day, you don't fully capture that move. Now here's the part most people miss completely. Even with that cap in place, TSPY still managed over 2% price appreciation over the last year, which tells you something important. This isn't just an income machine. It still participates in market growth, just in a controlled way. But controlled is the key word here, because if you misunderstand how aggressive this daily reset strategy is, you might be surprised by how it behaves in strong trending markets. So if your primary goal is income and you're comfortable with capped intraday upside, TSPY can be a serious contender in an S&P 500-based income setup. But here's where strategy really matters. If you start shifting toward total return plus income balance, then other funds in this category start making more sense. Funds like GPIX and SPYI. they're structured differently. Instead of maximizing income aggressively, they aim for a more balanced capture of upside and distribution. And as a result, they've delivered around 17 to 18% total returns, which makes them more attractive for investors who don't want to sacrifice growth completely. So the real question in this category isn't just which ETF pays the most, it's do you want maximum monthly income or balanced growth with income attached? Because choosing wrong here doesn't just change your yield, it changes the entire behavior of your portfolio. Category 2. NASDAQ 100, Tech Income Without Sacrificing Growth. If the S&P 500 is the foundation, the NASDAQ 100 is where growth investors tend to concentrate. Apple, Microsoft, Nvidia, this is where innovation lives. But there's a problem. This is also one of the most volatile parts of the market. So when you add income strategies here, the goal isn't just yield, it's surviving that volatility while still getting paid.
That's where QQQI, NEOS NASDAQ 100 High Income ETF, stands out. And yes, it has already appeared in this list before. Back in December, it was leading this category, and it's still holding that position today. On paper, around 13.9% distribution rate, around 5.4% one-year price return, and it passes our filters without breaking structure. But here's what actually matters. Because in a tech-heavy index like NASDAQ 100, you're not just dealing with slow price movement. You're dealing with sharp spikes, sudden drops, and momentum shifts. So any covered call strategy here is constantly walking a tightrope. Too aggressive and you cap too much upside. Too passive and you lose the income advantage entirely. Now there's another layer most investors miss completely: tax structure. If you're holding these inside a taxable brokerage, you need to be careful with funds like GPIQ and QQQA. They use ELNs, structured instruments that can behave differently from standard covered call mechanics. And while they can be powerful for income generation, they are not equally efficient in every account type. Inside tax-advantaged accounts like a Roth IRA, they can make significantly more sense. Outside of that, they may introduce inefficiencies most investors don't even realize they're paying for. And this is where smart income investing really separates from average investing. It's not just about picking high-yield ETFs. It's about matching the right strategy with the right market inside the right account structure. Because one wrong setup here doesn't just reduce returns, it can quietly drain efficiency over time without you noticing it. So as we move forward into the next category, keep this in mind. Every index behaves differently under covered call strategies, and what works for stability in the S&P 500 doesn't always translate cleanly into tech. Category 3. Russell 2000, the small cap opportunity. Now, this is where things start to shift, because up until now, we've been talking about large, established markets. But small caps tell a completely different story. The Russell 2000 is made up of smaller companies, businesses that don't have the balance sheet strength of mega-cap tech. And because of that, they react very differently to interest rates. Here's the pressure point most investors miss. A large portion of these companies carry floating rate debt. So when interest rates rise, that debt becomes expensive fast. Profits shrink, growth slows, prices get hit hard. And that's exactly what we've seen in recent years. Small caps have been heavily discounted compared to large cap tech. But here's where the opportunity emerges. Because if, and this is the key uncertainty, if the Federal Reserve continues to cut rates, the relief doesn't just trickle in slowly. It can hit balance sheets almost immediately. Debt pressure eases, earnings improve, sentiment shifts. And historically, when that rotation begins, small caps don't just recover, they tend to move fast and aggressively compared to large caps. Now, here's the tension most investors ignore. That rotation hasn't fully happened yet, which means positioning here is partly about timing and partly about accepting volatility while you wait. But volatility in this case is not just risk. In a covered call strategy, volatility is actually fuel, because higher volatility increases option premiums, which directly increases income generation. So what's normally a drawback in small caps becomes an advantage in this structure. That's where IWMI, NEOS Russell 2000 High Income ETF, comes in. It combines a Russell 2000 foundation with an out-of-the-money covered call overlay. and the result is around 14.7% distribution rate, around 8.5% price growth over the past year, which is rare because you're getting both income and participation in a recovering small cap trend. But here's the important part. This is not a set it and forget it allocation. Small caps are cyclical. They don't move in straight lines. So holding something like IWMI requires understanding where you are in the economic cycle, not just chasing yield numbers. So if your portfolio is heavily weighted toward mega-cap tech, this category gives you something very different. Diversification that isn't just theoretical, but actually tied to a potential macro rotation that's still unfolding. And that's exactly why it matters right now, because the biggest gains in small caps often happen before the market fully agrees they're safe again. Category 4. Gold, turning a dead asset into a monthly paycheck. Gold gets a lot of attention, and for good reason. It has just delivered a 76% move over the past year, making it one of the strongest performing traditional assets. But despite that performance, gold has always had a structural limitation. It produces zero income. No dividends, no interest, nothing. You're completely dependent on price movement, which means your capital just sits there waiting. That's exactly the problem IGLD, FT-Vest Gold Strategy Target Income ETF tries to solve. But here's the important part. It doesn't simply add yield to gold. It rebuilds how gold exposure is constructed. Instead of holding physical gold or even directly tracking it in a traditional way, IGLD uses a synthetic replication strategy. It combines long call and short put positions on GLD, effectively mimicking gold's price movement without directly holding it. Now that structure creates something powerful. It frees up a portion of capital to be deployed elsewhere. That freed capital is then placed into US Treasuries, which immediately introduces a base layer of interest income. So now, instead of a non-yielding asset, you already have an income-producing structure underneath it. But that's only the first layer. On top of that, IGLD applies a covered call strategy, but not in a fully aggressive way. Instead, it uses a target income model, aiming to generate approximately 3.85% above the 1-month Treasury rate each month. That's not random yield chasing, it's structured income targeting. Now, here's where it gets strategically interesting. IGLD uses a partial overwrite approach, meaning it does not cap the entire position. So if gold continues to rally strongly, you still participate in a portion of that upside. That's a critical difference compared to more aggressive covered call ETFs that fully sacrifice upside for income. Now, the results over the past year look extremely strong on paper, around 21% distribution rate, around 41% price appreciation, which is unusual because gold itself typically produces no income at all. So here you're getting both price movement and structured income generation. But here's the part most investors should not ignore. This level of distribution is not something you should assume is permanent, because when you see high yield combined with strong price appreciation, you have to ask a simple question. Is this coming from consistent income generation or from favorable market conditions that may not repeat? And that distinction matters, because synthetic strategies, by design, are more complex than they appear on the surface. They work extremely well in certain environments and behave very differently in others. So IGLD is not a set-it-and-forget-it gold replacement. It's a structured income overlay on a volatile asset class designed for investors who understand both the upside potential and the limitations. And in a balanced portfolio, that combination, income plus inflation hedge plus partial upside exposure, is what earns it a place on this list. Category 5. Niche and single asset funds. High octane, handle with care. Now, this is where things start to shift into the extreme, and this is where the conversation stops being about optimization and becomes about risk awareness, because everything up until this point is diversified income strategies. What comes next is not. Providers like YieldMax have created a different class of ETFs entirely, funds that don't just track broad indexes, but concentrate exposure into single sectors or even single stocks, all powered by the same synthetic covered call engine, but compressed into one high volatility position. and the results can look almost unreal. Take GDXY, for example. It targets gold mining companies, already one of the most volatile segments in the market, and currently shows a distribution rate exceeding 100%. Yes, over 100%. But before you interpret that as free income, you need to understand what that number actually represents in practice, because extreme yields like this often come with extreme structural trade-offs. Then you have GUEY, which focuses entirely on a single stock, Google, and it reports distributions above 39%, which sounds powerful until you realize there is no diversification buffer at all. Funds like SOCKY and BIGY take a slightly broader approach. SOCKY focuses on semiconductors, BIGY on the top 50 US companies, both targeting roughly 12% income yields, which places them closer to the controlled high-yield category. Now, here's the core reality you must understand. The upside in these funds is obvious. If you correctly time the sector or the underlying stock performs strongly, the income can feel extraordinary. But the downside is not theoretical. It is concentrated, amplified, and simultaneous. There is no diversification layer protecting you. So if a stock like Google faces a severe downturn, whether from regulatory pressure, earnings collapse, or market repricing, a fund like GUEY doesn't just reduce income, it can see distributions shrink or disappear entirely, while the underlying capital is also falling at the same time. Both risks, income and principal, happening together.
That is the specific danger here. So these funds are not designed for stability. They are not designed for retirement foundations. They are not even designed for core portfolio allocation. Their role is extremely narrow. Satellite positions only. High yields, tactical instruments sitting on the edges of a properly diversified portfolio. Not the center, not the base, not the plan. Because if you reverse that hierarchy and treat these as core income generators, you are no longer building a portfolio. You are taking concentrated directional risk with an income wrapper on top of it. How to think about combining these? The allocation framework. Here's the part almost every video leaves out. They show you the ETFs, but never show you what happens when you combine them incorrectly. And in income investing, that mistake is where portfolios quietly break. So think of this system in 3 layers. Not as choices, but as risk zones inside one structure. 1. The core, 60 to 70%. This is your foundation. Funds like TSPY, QQQI, and IWMI sit here. These are not just income generators, they're your stability layer. Broad exposure underneath, covered call overlay on top, balanced between income and survivability. But even here, the risk is not zero. Because if you over-allocate here based purely on yield, you slowly drift away from diversification without realizing it. 2. The alternative layer, 20 to 30%. This is where IGLD fits. Different asset class, different behavior, different cycle exposure. It doesn't move like equities, which sounds like a benefit, until you realize it also means it behaves unpredictably when correlations shift. This layer exists for one reason: to stop your portfolio from becoming too dependent on a single market regime, but misusing it can create imbalance instead of protection. 3. The satellite layer, 10 to 15% max. This is where things get dangerous if you're not disciplined. Funds like GDXY or GUEY live here. High yield, high volatility, high uncertainty. This is not extra income. This is directional risk with an income wrapper. And if you overweight this layer even slightly, your entire portfolio stops behaving like an income system and starts behaving like a leveraged bet. So the structure is simple, but not easy, because the danger isn't picking the wrong ETF, it's misplacing it in the wrong layer. And that's how portfolios that look strong on paper slowly become unstable in reality. So let's step back. What you've seen isn't a list of ETFs, it's a framework for building monthly income using covered call strategies across 5 different market exposures. And when structured correctly, it can generate meaningful monthly cash flow without requiring a multi-million-dollar portfolio. Not as a theory, not as a projection, but as an operating system. I know this because I've built it myself, but the important takeaway is this: you're not trying to maximize yield. You're trying to balance income, capital stability, and long-term survivability, because chasing the highest number on a screen is exactly how most investors end up disappointed later. The traditional retirement model tells you to accumulate, wait, and then withdraw. This is a different approach. Build income streams now, layer by layer, with structure instead of speculation. If this changed how you think about income investing, you'll find more breakdowns like this in the next videos, including how these ETFs behave in real market crashes, how taxation actually impacts your net yield, and what happens when volatility completely disappears. That's where things get even more interesting. I'll see you there.